This is Roxanne Broughton, Commercial Loan Officer with the Finance Authority of Maine. Thank you for joining me for today's presentation of what is best for your borrower. I'm very excited as this is FAME's first commercial webinar, and I have the privilege to be your presenter. Today's webinar will provide a review of FAME's online services, noted as OLA, and our traditional paper application for commercial loan insurance. We will review options between leveraged loan insurance and pro-rata insurance by using a comparative tool developed by FAME. This tool can be located on FAME's website under Commercial Loan Insurance Traditional Application. I'd like to ask you to hold your questions until the end of the presentation. And if I don't have time to address all the questions today, I will certainly answer them via email afterwards, and that email will go out to everyone. The webinar will be recorded for future reference, and we will provide a link to the recording and PDF slide after the webinar concludes. Okay, let's get started by reviewing our agenda today. We will cover FAME's commercial loan insurance options, what's new at FAME, and lastly, what works best for your customer, leveraged or pro-rata insurance. The next slide is an overview of what FAME currently offers through our online services. And although the majority of today's attendees may be familiar with these options, others may not be. Please keep in mind all loan amounts referenced are noted as FAME's exposure. And let's begin with a review of pro-rata loan insurance. You can obtain up to 75% insurance on loans in the amount of $500,000 and up to 60% loan insurance between $500,000 and $750,000. Pro-rata insurance is also available on existing loans that have never been insured before. This option provides up to 40% of insurance on loans up to $500,000, although there are certain requirements that are detailed in your partner guide on page 201. And I'd like to briefly go over an example for you now of when that 40% might be helpful for you. So let's say you had a customer that you provided a $100,000 loan for, and you were comfortable with the situation and didn't require commercial loan insurance. And now that borrower has come back to you and they want a $100,000 line of credit. And now you'd like to obtain the commercial loan insurance. So we can provide the 40% on the existing debt, and depending on what your choice is versus OLA or traditional, you can get 75% or 90% on the new money. And what we would do for you is blend the rate between the existing debt and the new debt. So that's an example of where that 40% commercial loan insurance is really beneficial to you as the banker. Now let's review what leveraged insurance offers. You can obtain 25% leveraged insurance on term loans up to $250,000 and 20% leveraged loan insurance on lines of credit up to $250,000. Again, please keep in mind all these figures represent FAME's exposure and not the amount of your bank loan. Next, we will review options available through the traditional paper application. And these options can be used if perhaps the online application just wasn't approved for you and you're still reaching for that yes answer for your customer. You can obtain 90% pro-rata loan insurance up to $5,250,000 and 25% leveraged insurance up to $2.5 million. Working capital lines of credit are capped at $1 million. Therefore, you can apply up to 90% pro-rata loan insurance or 20% leveraged loan insurance up to that $1 million mark. Now let's review what's new at Fame. Through the voice of the customer, we gathered information by listening to each of you and made some exciting new changes that are beneficial to everyone. First, leverage insurance is now available through our online service referred to as OLA. Secondly, we created a new online comparison tool allowing you to test and determine what works best for you, leverage or pro-rata insurance. And again, this tool is located at famemaine.com. And lastly, we heard you say collecting that annual fee could be difficult at times. Therefore, we now offer you multiple options to select from. Term loans now have a fee option of 1, 3, or 5 years. And line of credits now have fee options of 1 or 3 years. These enhancements were suggestions taken from each of you through the voice of the customer and were instrumental in streamlining efficiencies. So thank you, everyone. The next 2 slides will provide us with examples of when leveraged or pro-rata insurance may be your best choice with benefits not only to you as the banker, but the borrower as well. This will be determined by using the online comparison tool from Fame's website. So first, let's get started by looking at when leverage insurance is best when the value of the liquidated asset is closer to the loan value. So you can see the loan amount. We plugged in $950,000. We used 25% leveraged insurance. We did a 75% pro-rata insurance. And we said the balance at default was $750,000. Liquidation of your collateral was $600,000 with some small incidental fees, interest, collection fees of $1,500. Coming down to the next block, you can see the loan amount was $950,000 for leverage. The same for pro rata. Your insured amount, 25%, 75% for pro rata. Insured balance is $237,500, $712,500 for pro rata. And you can see your year fee, 1 year fee, and this fee is 3%. This actually incorporates your commitment and your annual fee for both pro rata and leverage insurance. So you can see your total fee for leverage is $7,125. Coming over to the pro rata side, $14,250 with a variance of $7,125. Coming down to the next block, loan amount of $750, default balance was $750, liquidation of collateral $600. Again, the reasonable fees of $1,500, and your lender's loss prior to submission was $151,500 for both leveraged and pro rata. The last box of this example presents how Fame pays their claims. So leverage claims are based on the lowest of 3 scenarios. The first example is 100% of the lender's loss, which was $151,500. The second is your loan balance at default plus collection fees times 25%, which was your leveraged insured. That equals $187,875. You can see the original loan balance insured was $237,500. So the leverage claim paid by Fame was $151,500, and you had 0% lender loss. Coming over to the pro rata side, you can see the first example with lender loss prior to submission of insured 75%, totaled $113,625. Your original insured balance of $712,500. Claim paid $113,625 with a lender's loss of $37,875. So we ask you at this time, the good example here shows you that your liquidation asset and your loan value were very close. And so by choosing the leveraged, you had an advantage where you had no loss to the lender. The next page is an example of when pro rata is best, when there is a greater gap between the original loan amount and the value of the collateral. So again, we use $950,000. We use the same insured amount for leverage and pro rata, except on the balance of default, I increased that by $100,000. And I reduced the liquidation of collateral, making a larger gap here. I kept the same fees of $1,500. The fees for both leveraged and pro rata remained the same. This box, you can see the liquidation was $500,000. So it showed a lender loss of $351,500 on both pro rata and leverage side. And coming down to the very last box, you can see 100% of the lender's loss was the $351,500. Loan balance at default, collection cost times the 25% was $212,875. And the original insured balance was $237,500. The paid claim was $212,875. Leaving you with a lender's loss of $138,625. Coming over to the pro rata side, you can see the lender loss prior to submission was $263,625, with the original insured balance $712,500. The claim paid $263,625. With the lender's loss of $87,875, which you have a variance here of $50,750. So for this scenario, your pro rata insurance was your better choice, leaving you with a lesser loss as the banker. I would now like to start taking audience questions at this time, and there will be a brief pause while I review each of them. We have one question that says one of our attendees is not getting any of the audio, and yes, there will be a recorded available after the session. So there will be something for you to listen to. We have another question that says, can a lender choose a 3-year guarantee fee and then go year by year if the loan is a 5-year term? And the answer to that question is unfortunately no. When you pay your 3-year fee, it's non-refundable at that point. So you really want to make your decision at the very beginning. If you feel that your customer isn't going to be required to have that insurance for 3 years, then I probably would suggest that you choose a yearly fee. So we have another question about the claim paid on the leverage side, and shouldn't that claim that should have been paid was $187,825. So keep in mind it's the lowest of all 3 scenarios, so the $151,500 is correct. We have another question of, is there a limit as to the amount of collection costs for FAME that FAME will pay? It actually just has to be reasonable collection cost and 90 days of interest. So it looks like we don't have any more questions. So moving to the last slide for future reference, I have included FAME's commercial lending team for future contact information. And this concludes today's webinar. I know you are all very busy, so thank you very much for taking the time to join me this morning. As I mentioned earlier, if your questions were not answered during today's presentation, I will certainly be addressing them by email throughout the day. But it does look like we were able to answer everything. But if you have future questions that you weren't didn't think of while we were doing the presentation, please feel free to email me directly at rbroughton, BROUGHTON @famemaine.com. We also plan to do more of these webinars in the near future. So if there's a topic you'd like us to cover, please let us know by reaching out to us via phone or email. And again, thank you all for joining me today, and have a wonderful afternoon, everyone.